Have you ever wondered where banks get the money and the land to businesses and individuals? Every day, billions of dollars flow to financial markets, but most of us never think about how this system works. Imagine you own a company and need a short-term loan to pay your employees. Where do you go? The answer lies in the money market. Welcome to Money Market. Hello everyone, I'm Shagal Chandrapal, and today we will explore the fascinating world of the money market where banks, corporations, and governments borrow and lend short-term funds to keep the economy running smoothly. So our topic is money markets. Now we're going to discuss about money market. What is money market actually? So, money market is a financial market where short-term borrowing and lending of funds occur. It deals with highly liquid and short-term financial instruments, typically with a maturity of 1 year or less. Now, we see 7.4.1 quantity theory of money and money market equilibrium. So, here we can see a graph between interest and demand for money or supply for money. I and MS or MS. So here you can see two curve, MS curve and MD curve. The red line or red curve is refers to MS curve and this curve is MD curve. These two curves intersect at a point and this point is called equilibrium point. So this point is equilibrium point and this point ms at this point ms is equals to mg. That means supply for money and demand for money is equal. And now we're going to discuss about quantitative of money and price. Here we can see a equation mb is equals to pq. Here m is nominal money supply, V, velocity of money, P, price level, Q, output or real GDP. Velocity is the average number of times a dollar is spent to buy final goods and services in a year. And we can write this equation as P is equals to V by Q into M, or P equals to K into M, or P is proportional to M. And suppose this equation is equation number 1. And this equation is called the stability equation, price stability equation, and it is also called a fundamental equation. And the main duty of a central bank is to maintain the stability of this equation. The equation also relates that an increase in the money supply leads to higher prices, which is inflation. A decrease in the money supply leads to lower prices, which is deflation. We can write as V is equals to P into Q divided by M, and here V is income velocity of money. The equation refers that the rate at which money is circulated in the economy. So now we're going to discussing about functions of the central bank. So the main goal of the central bank is price stability. Price stability. So the goals of central bank: price stability, maintaining economic stability, reduce unemployment. So Price stability means controlling inflation by managing the money supply and interest rates, maintaining stable prices to avoid both inflation and deflation. Maintain economic stability means supporting policies that promote sustainable economic growth, ensuring that growth is neither too slow nor too fast. Reduce unemployment means striving to achieve the highest possible employment level without causing inflation, balancing unemployment and job vacancies to maintain a healthy labor market. Now we see about functions of the central bank. So, which are the functions of the central bank? First, conducting the monetary policy, maintaining the stability of the financial system, containing the systematic risks, providing financial services to bank and services. So now we see what this means conducting monetary policy. Fixed exchange rate. Exchange rate targeting conduct monetary policy to maintain year fixed. Monetary targeting, where E is proportional to M. Interest rate targeting, where interest and M is inversely proportional. If I is declining, M is increasing. And inflation targeting. Maintaining the stability of the financial system means supervising bank and financial supervision. Supervising bank and financial supervision. Containing the systematic risks means lender of the last resort. Providing financial services to bank and services. And here we can see a graph which shows that the stable and unstable situation in the picture. So we can see the stable and unstable situation. So now we're going to talk about monetary policy tools. So now we're going to talk about monetary policy tools. So the central bank uses several key tools to manage the economy, control money supply, influence interest rates, and stabilize financial markets. Below are the detailed explanations of three important monetary policy tools. At first, we see open market operations, OMO. So OMO involve the buying and selling of government securities in the open market by the central bank. This transaction directly influences the money supply and interest rates. And policy interest rates are two types: repo rate, reverse repo rate. So repo rate, the rate at which the central bank lends to commercial banks. Lowering the repo rate makes borrowing cheaper, stimulating the economy. Raising the repo rate makes borrowing costlier, controlling inflation. Reverse repo rate, the rate at which the central bank borrows from commercial banks. Reverse repo rate means the rate at which the central bank borrows from the commercial banks used to absorb excess liquidity. And then required reserve ratio. Using required reserve ratio, central banks press money and liquidity of management and liquidity of management, central bank lending facilities like discount rate, lender of last resort, the interest rate charged by the central bank for short-term loans to commercial banks. This is discount rate. Higher discount rates discourage borrowing, tightening monetary conditions. Lower discount rates encourage borrowing, enhancing liquidity. Lender plus returns result. Central banks provide emergency funds to banks facing liquidity issues. And now we see relationship between money and output. Now we're going to discussing about relationship between money and output. So at equilibrium money market, money supply and interest rates have an inverse relationship. A larger money supply lowers market interest rates, making it less expensive for consumers to borrow. Conversely, smaller money supplies tend to raise market interest rates, making it pricier for consumer to take out a loan. If money increasing, interest increasing. So equilibrium between money market. The equilibrium in the money market is a key concept of macroeconomics, representing the point where the demand for money equals the supply of money. This equilibrium determines the interest rate in the economy. Here's a detailed description. So, key components of money market equilibrium are money, demand for money, and supply for money, equilibrium, interest rates. So, demand for money. The demand for money represents how much money individuals and business want to hold at different interest rates. It is typically downward sloping because at lower interest rates, the opportunity cost of holding money is low. So people prefer to hold more cash. At higher interest rates, the opportunity cost of holding money increases. So people prefer to invest or save, reducing the demand for money. Supply of money. The supply of money is controlled by the central bank, the Federal Reserve in the US. It is usually represented as a vertical line because the central bank sets the money supply independently of the interest rate. Equilibrium interest rate. The equilibrium occurs where demand for money intersects the supply for money, and intersecting point is the equilibrium point. Here you can see three equilibrium points, and this equilibrium point, supply for money and demand for money is equal. If money decreases, interest increases. If money increases, interest decreases. And again, we have the equation y is equal to c plus I plus g plus nx. So here you can see a graph between c plus I plus g and y. So if investment increases daily unit, then output shifts forward from y1 to y2. So the relation between investment and output are positively proportional. If investment declining, output declining. If investment increasing, output increasing. So For increasing money, aggregate demand will shift upward. Aggregate demand will shift upward, and as a result, output Y also be increased. So the relation between money and output is proportional. If money increasing, output increasing. If money decreasing, output decreasing. So here we can see for increasing money, aggregate demand will shift forward. This is the aggregate demand shift forward curve from this. And for this, output Y also will be increased. So, well, uh, thanks for watching this money markets video. Thanks everyone.